Okay, we're gonna start covering chapter 5 today. We're skipping chapter 4 because it's basically time value of money. You should have seen it in your accounting classes. Probably it should have been covered in Excel class as well. If it's not, well, what can I say? I mean, you're not directly responsible for that material, but that doesn't mean you're not going to use those concepts. It's basically the idea of calculating present value of future cash flows. That's pretty much all the skills we're going to need. And we're going to use them as needed. Now, what do we do in this chapter? We're going to start talking about capital budgeting process. Capital budgeting is basically about the idea of making decisions about potentially profitable investment projects. All these could be a new product, making updates to existing products, buying certain assets, buying certain firms, merging, what have you. And by their nature, they tend to be somewhat longer term. I mean, that doesn't mean there aren't short term investment projects, but they're more uh, like working capital kind of management issues. So we're going to talk about essentially acquiring or putting place in assets that are expected to generate cash flows for the firm over a long period of time. What's your name? Kyle? Caleb, okay. Capital budgeting has essentially three distinct portions. The first one is called calculating or estimating cost of capital. Your name? Braden? Latham, right? What we mean by cost of capital, it is basically the discount rate that is hopefully adjusted for the risk of the project that is used to discount future cash flows. Not all projects are created equal in terms of risk. Example, suppose you're NVIDIA 5 years ago. You know, NVIDIA started thinking about their data center GPUs. That is obviously a pretty long-term project, but it is also risky. On the other hand, they already had business with respect to graphics chips or graphics processors for gaming computers. Making updates on those or improvements doesn't mean it's riskless, but relatively speaking, it's not as risky. So if I compare those two projects, I wouldn't use the same discount rate. I would discount the expected cash flows from a AI kind of chips at a higher rate compared to the well-known area for the graphics GPUs. The second component is forecasting. A better term is probably projecting. Well, if I'm going to make decisions about a project, I need to figure out how much does it cost to put in place, plus how long do I expect to generate cash flows from this project, the life of the project, and how much cash flow do I expect in each year. And various so-called investment rules or criteria. Normally, the process of doing this, the order of one and two can change, but uh, the three is actually done the last. But we're not going to do our coverage in that way. First, in this chapter, we're going to act as if somebody told us what that cost of capital is, and somebody told me what the projected cash flows are. So we're going to take them as given. Given those, we're going to analyze the pros and cons of different investment rules or investment criteria, how they can be used in combination, if there are conflicts between the decision criteria, what do we do about it, so on and so forth. Now, we want some desired properties. We have all these inputs. We have the cost of capital, we have cost of putting the project in place, and we also have projected future cash flows. Given all these multiple inputs, an investment rule is the single number that is a function of these inputs that is used to make a decision. Given this many inputs, presumably you can come up with a lot of criteria. But we want certain minimal things about it. One, we want the criteria use all of the cash flows sounds like a reasonable request, right? If I'm going to make a decision and I have all these inputs, we should use all of them. Don't leave anything out. Take riskiness of the project into account, which means do not treat a risky project same as another project that is less risky. Different firms will have different risky projects. Even within the same firm, multiple projects may have differentials on how risky they are. We also want into account. That's a fancy way of saying do not treat $100 next year the same as $100 10 years from now. Unless you're in a negative interest rate environment, which you're probably thinking, is that a joke? Could interest rates be negative? Well, about 3 years ago, or during COVID years, if you wanted to invest into 30 years bonds of the Swiss government, let's say you gave them 10,000 francs, every year, essentially, the Swiss government told you at the end of the year, please pay me another, let me see, 300 francs just for the privilege of me keeping your money. Uh, it is possible, and when we talk about the bonds, we're going to talk about why that is possible. I mean, normally, if you keep your money at home, you have zero interest rate, right? So why would you get negative interest rate? Well, if you're talking about $100 in your pocket, obviously you wouldn't do it. But if you have $10 billion, where are you going to keep it? You're going to keep it at a bank. If you keep it as cash in your vault, there's also some risks. Yeah, insuring that is going to cost you money. So instead, you get negative interest rates. And we want the criteria to provide a measure of how much value would be added to the firm if the project is accepted. These are rather, minimal things. I want to use all the inputs. I want to make a distinction between the riskiness. I don't want to treat 10 years, $100 10 years from now, same as $100 next year. And at the end of the decision, I want to know what sort of value I'm adding to my firm. Turns out there aren't that many criteria that satisfies all these minimal desirable properties. There is actually one among the ones that we're going to consider that satisfies all of these. It's called net present value, or NPV. As the name suggests, this is the present value of all future cash flows from the project, less the cost of putting the project in place. So let's introduce some notation.